Stay with this video from beginning to end. Every section is built on the one before it, and if you jump ahead, you will miss the structural argument that makes the conclusion make sense. This video runs approximately 10 to 12 minutes. That is a small investment of time for the level of data we are going to walk through together. Watch it completely. In the last video, we identified $103 as the critical hourly body close level for silver. We said that if silver failed to hold that level on a closing basis, the next significant support cluster was sitting between $88 and $91. We also said the COMEX open interest structure suggested a flush was more probable than a breakout. That call was made before the move happened. It played out precisely as described. New viewers, go check the previous video. The timestamps are there. You do not have to take my word for it. The data said what it said, the level held the analysis, and the price confirmed it. Now let's get into what is happening today. Silver dropped from $121.40 to $82.10 in exactly 36 calendar days. That is a decline of $39.30 per ounce, representing a 32.4% collapse from peak to trough in just over 5 weeks. In dollar terms, if you are measuring the total notional value erased from the global silver futures complex, you are looking at an estimated $180 billion in paper market capitalization wiped in that single move. Western spot silver tracked the futures market almost tick for tick. COMEX front-month contracts registered intraday lows not seen since silver was recovering from the 2020 COVID crash. The speed of the decline was not gradual. The sharpest single-session drop of $14.60 occurred in a 43-minute window during the early London session on a Tuesday. No news event hit the wire at that moment, no scheduled data release, no Fed statement, nothing. That question needs an answer. On the surface, this makes no sense. Here is why. The macro backdrop during this exact 36-day window included renewed currency instability in 3 G20 economies, rising geopolitical tension in 2 active conflict zones, and a US dollar index that actually weakened 2.3% over the same period. Under conventional market logic, a weaker dollar combined with geopolitical stress is precisely the environment where silver strengthens, or at minimum holds its ground. That is the textbook relationship every financial institution teaches its analysts. What actually happened was the opposite. Silver collapsed 32.4%, while the conditions that historically support silver were all present simultaneously. Most people watching mainstream financial coverage never asked why. That gap between what should have happened and what did happen is exactly where the real analysis lives. While Western paper silver was in free fall, the Shanghai Gold Exchange and the Shanghai Futures Exchange told a completely different story. During the same 36-day window, the physical silver premium in Shanghai over London spot ranged between $4.20 and $7.80 per ounce. That is not noise, that is a structural divergence. SGE Vault data showed a net drawdown of approximately 1,240 metric tons of silver inventory over that period, which means physical demand was absorbing metal even as paper prices crashed. Chinese industrial buyers, particularly in the solar panel manufacturing and semiconductor sectors, were accelerating purchases. On Chinese e-commerce platforms tracking silver bullion retail sales, volume data spiked 38.6% week over week during the sharpest phase of the Western price decline. Physical demand in the East was rising precisely as paper prices in the West were being crushed. You will not hear that framed this way on mainstream financial media. That divergence is not accidental. 2 geopolitical currents were running hard during this 36-day window, and both connect directly to the silver price move. First, the Federal Reserve's internal communication, specifically the minutes released in week 3 of this period, contained language that multiple institutions interpreted as signaling a longer pause on rate cuts than the market had priced in. That language caused a repricing event in real rates, and rising real rates historically pressure non-yielding assets. That was the cover story. The second current was more structural. The U.S. Treasury was managing a bond rollover of approximately $2.1 trillion in short-duration debt during this exact window. When bond market stress peaks, institutional desks reduce their commodity exposure to cover margin and liquidity requirements elsewhere. Ray Dalio described this exact mechanism in his work on the debt cycle, noting that the most dangerous periods for hard assets are not bear markets. They are liquidity events masquerading as fundamental repricing. The combination of Fed rate language and Treasury rollover pressure created a coordinated macro justification for the move, but that still does not fully explain the 43-minute flash event. That requires the next layer. Let's go to the documented record. JP Morgan Chase paid $920 million in fines in 2020 to resolve charges of market manipulation in precious metals futures. The Department of Justice described the practice as spoofing, a technique where large orders are placed and immediately canceled to create artificial price signals that trigger other traders' stop-loss orders. This is not a conspiracy theory. It is a verified federal settlement. The structure is always the same. A concentrated short position is built quietly over days or weeks in the COMEX futures market. When the position reaches sufficient size, a high-volume sell order hits during a low liquidity window, typically early London session, or the gap between Asian close and New York open. Stop-loss cascades trigger automatically. Prices fall faster than any fundamental news event could explain. Then the short position is covered at the lower price. During the 36-day period in question, CFTC data showed that the 4 largest commercial short holders in COMEX silver held a combined net short position of 312 million ounces at the peak. Don't trust me on this. Verify it yourself using the CFTC Commitment of Traders report. The data is public. Once you see that number, the 43-minute move stops looking random. From a technical standpoint, the level to watch on the recovery side is $94.50. That is where the 150-period exponential moving average on the hourly chart converges with a previous high-volume node from early in the year. For a valid recovery signal, you need a confirmed hourly body close above $94.50, not a wick, not an intraday spike, a full candle body closing above that level. On the downside, the structural support is at $79.80, which aligns with the 2023 consolidation base. A confirmed hourly body close below $79.80 opens a retest of $72 to $74. Open interest on COMEX silver declined 18.3% during the flush, which historically indicates short covering is beginning rather than fresh selling. That matters for timing. Implied volatility on silver options remains elevated at 42.7%, meaning the market is pricing in continued instability. This is educational analysis only, not financial advice. Intellectual honesty requires this section. There are real arguments against the bull thesis right now, and they deserve a straight hearing. First, if real interest rates stay elevated for longer than the market currently expects, silver's opportunity cost remains structurally high, and that is a genuine headwind, not a temporary one. Second, Chinese industrial demand, while currently strong, is tied heavily to the solar manufacturing cycle, which faces overcapacity risk in 2026. If that sector slows, the physical demand floor in Shanghai weakens. Third, the honest read on COMEX positioning is that while large shorts are present, that positioning has persisted for years without triggering a sustained reversal. Presence of manipulation risk is not the same as certainty of reversal timing. These are not trivial objections. The data does not yet confirm that the bottom is in. That must be stated clearly. But here is what did not change. COMEX registered silver vault inventories have declined 34.2% over the past 18 months. That is a documented, verified trend that one 36-day price crash does not reverse. Physical demand in Asia absorbed over 1,240 metric tons during the same window the paper price was collapsing. That is a structural floor being built from the east. The Shanghai-London premium did not invert during the crash, meaning Eastern buyers never lost confidence in physical value. COMEX lease rates spiked to 4.8% annualized during the flush, which historically signals physical tightness, not abundance. The industrial silver deficit, driven by solar and electronics demand, is running at an estimated 140 million ounce annual shortfall, according to the Silver Institute's latest documented figures. Price does not always reflect fundamentals in real time. Watch vault inventory levels and the Shanghai premium, not just the spot price. That is where the real signal lives. Follow the official handle for real-time updates between videos. That is the only place where current data and level alerts are posted as they develop. Thank you to everyone who watches this content carefully and engages with it seriously. That kind of audience is what makes this channel worth building. Invest with logic, not hype.